Welcome back. You're watching Stock Watch with me, Simon Brown, and joining me to take your stock-related questions tonight, Wayne McCurrie from FNB Wealth Investments and Deryck Van Rensburg from Anchor Capital. Please be sure send your questions. Email stockwatch@bdtv.co.za, SMS 41392, or on X using hashtag StockWatch. Gents, appreciate the time today. Wayne, I'm going to start with you. I'm going to start with Capitec. The stock's almost doubled since its 52-week lows. It's up 15-fold in a decade, 30-fold in 2 decades. The question coming through this morning was, is there value here? I mean, it's on a PE of 34-ish, but it grew revenue HEPS by 36. Is Capitec still a buy, or has it just got to that rarefied, scary air place?
Look, obviously it's a very, very good question and very pertinent question. When I looked at their last set of results, I said this doesn't justify, 3 times the other banks' ratings, 4 times the other banks' ratings. But these earnings now at 30% plus and dividend up 30%, to be honest, it probably does justify the rating. I mean, obviously the lows were, the recent lows were the middle of last year. And if you were fortunate enough to have bought it then, you'd do well. Look, they face the same struggles that everyone else faces, but they seem to be able to grow into the other banks' space and grab other banks' customers. And they're upping their offering every couple of months. They got new offerings out there. So I think, yes, I think it is a holding, but, don't go massively overweight because, eventually, you can't sustain 30% plus earnings growth into perpetuity, which is what the rating is almost saying. But it's obviously a very good operation. So, yes, I would say there is value, but, don't put all of your money into it. You can put a measured exposure to it.
Deryck, your take, because I agree with what Wayne said. If I read the results 6 months ago, I thought, man, the stock looks expensive. I read them yesterday and I'm like, maybe not. What's your take on Capitec?
I think Wayne has summed it up there, where the price or the valuation is justified given the growth trajectory that they've been delivering to the market. So just looking back 10 years and obviously where they are at the moment, I think you need to salute management and what they've been able to achieve in a very tough economic environment. The numbers are clearly indicative of stealing market share from the other banks.
Yeah.
And the big question is, when does it become less of a growth story where you start to see earnings growing kind of mid-teens as opposed to where they are at the moment? And you probably got another couple of years in you. At least, we said that actually 3 or 4 years ago, but they continue to grow at this rate. So I certainly wouldn't bet against it. If I've got them, I'd hold them. They're probably looking a bit lofty in the very short term. So if you do see a bit of a pullback and some weakness, it probably does justify a position within a portfolio. But as Wayne said, you don't want to throw the kitchen sink at it and go overweight. But a good quality business that probably does justify a holding or a position within the context of a portfolio.
Yeah, I take your point. And it was. 3-4 years ago, we all looked at it and thought, how much more can they do? Apparently a heck lot. Deryck, staying with banks, a question came through saying, I want to buy ABSA. It looks like the cheapest of the big banks, and it certainly is. And our banks are all well capitalized. They're all paying decent dividends and the like. What about ABSA as sort of the other side of the extreme from Capitec?
Yeah, I think that all of the SA banks at the moment actually look quite good. They're all making new highs if you just look at the run that FirstRand has had. And the sentiment is obviously certainly very positive towards South Africa. We're all targeting better growth rates and better growth trajectories from a South African economic perspective. I like ABSA. They're all quite closely correlated. I do think that there's some value there. It sits with a decent dividend underpin as well. So it kind of pays you to be patient and hold it. And I do think that they probably put a lot of the bad news in their last reported numbers through the system. So call it a low base that they're kind of working off relative to the other banks or relative to something like a FirstRand. So hopefully we do start to see some improvement in terms of earnings trajectory. So long short story, I like it, and I would be a buyer of ABSA.
Take your point. Wayne, ABSA as an offering, as I said, the sort of other extreme to Capitec?
Yeah, look, I mean, ABSA just looks dirt cheap, but maybe it looks dirt cheap for a reason. It can't get any worse. We're going into, as Deryck said, we're going into a good environment, lower interest rates, less bad debt provisions probably going forward. They'll get some growth. Lower earnings initially is not good for banks. It actually squeezes their margins a little bit unless they've done the correct interest rate hedging, which most of the banks actually do. So yes, I would buy ABSA, but I would prefer to buy Standard Bank. But ABSA is fine, yeah.
Deryck, what would be your preferred bank in this space?
I think, just call it from a quality perspective, I've always kind of favored and leaned towards FirstRand. Obviously, the valuations are a little bit higher relative to the other banks. I mean, take Capitec out of the equation. Sure. But I think it's always been a good quality bank that's kind of delivered consistently through the years. So my preferred bank within the sector, FirstRand. But if you're looking for more of a valuation play, focusing more on fundamentals, then obviously ABSA jumps out from a fundamental perspective. But in terms of quality, FirstRand.
Let's stay with you from which you had Deryck. Question coming through: can we buy Boxer shares? They're not listed, and as I understand, they're not going to IPO. They're going to do book build, and they will list later in the year. We don't know a heck of a lot. I think Pick n Pay actually said they're going to give some more information tomorrow. But intuitively, Boxer looks like a good bet, certainly within the Pick n Pay broader stable.
Yeah, I certainly think so. And if you go into the detail of some of the last financials that Pick n Pay have released, you can see this is the big growth driver when it comes to Pick n Pay's value at the moment. So if you are a Pick n Pay shareholder, there will be an unbundling and you will land up with some Boxer shares. But in terms of new issued shares that come to market, because I think that's really what's going to happen, that's going to be, call it, placed with certain institutions and key shareholders, obviously backing the story, but certainly a good quality business. I'm actually quite excited for this listing when it does come to market, and obviously we've got to keep a close eye on it.
Wayne, Boxer, as Deryck says, we've got some sight of them from the results. Looks like a good business, looks like operating in the right space and doing quite well when it becomes a standalone.
Yeah, I also like it. I think there will be some shares that will trade, obviously, once they've listed. Probably have a fairly low trade, but for the proverbial private investor, you will be able to get some. Yeah, I do like it. And, as these things normally do, they come on the market at reasonable prices. And then if it is a good business, it can rally quite strongly initially. So you must try and get some, I would think.
Yeah, so that then takes him to the next one, which we had a question around, which came through my Twitters. We buy cars. I mean, it came to market, around 20. It's done very well. Is there still value in We Buy Cars? Wayne, let's stay with you a moment.
Yeah, look, I mean, I always get told the story when I go into meetings of how cheap We Buy Cars is from our research department, and I agree with them. Even if you take a very, very conservative view on their earnings growth going forward, the company does look cheap. So yes, I do like it.
Deryck, and certainly what they have done is change the second-hand car market from what anecdotally people say it's actually a pleasant experience, whereas truthfully buying second-hand cars never used to be a very fun experience. Your take on We Buy Cars at now almost $30 a share?
Yeah, so I think on paper, if you just look at PE multiples and look at the valuation today, it's going to come across expensive. But I think just given the growth trajectory that they're heading on and continue to head on, I still think that there's some runway left in it. And there's no reason, with a bit of positive market sentiment, a little bit of a more accommodative interest rate environment, which we're seeing at the moment, consumer spend starting to pick up, discretionary spend starting to get a bit thicker at the moment, then I think We Buy Cars is well positioned just from a macroeconomic perspective. So I would say that the valuation is justified. I still think that there's some runway for some decent growth out of the business, and I think it definitely deserves a home in a portfolio.
Deryck, let's stay with you. Sibanye Stillwater, been a horror stock the last little while. Obviously, they've got some gold. That's done well, but they're mostly PGMs, platinum and palladium, sitting around $1,000 as we speak. Is Sibanye Stillwater one worth having a nibble at, or is it a rather wait and see?
Well, I mean, since we've seen their results, we saw the share price run from 14 odd rand to where it is at the moment, 19 rand plus. And I think the market was concerned that they may need to do a rights issue just to kind of weather the storm that they've been through over the last 2 years. PGM prices are soft, and that certainly had an impact on a cash flow and negative earnings environment for Sibanye. That wasn't the case. They managed to forward sell some of their ounces of platinum and palladium, and they've also they've put one of their mines within the Stillwater stable under care and maintenance, which has actually picked up the PGM underlying commodity prices. So things are looking better. The fact that they didn't do a rights issue was well received by the market. The share prices have rallied, and the whole sector's actually rallied. I would say that it's the riskiest bet within the PGM space. If you just look at Sibanye, Northams, Impalas, and even Amplats for that matter. So it is quite risky, just given where the balance sheet is at the moment. If you are going to play in the space, I would probably lean towards Northam, which is a little bit more cash flush than Sibanye right now. So still a very difficult environment for them to navigate. But yeah, it's all going to be based on how much further these platinum and palladium prices run from here.
Yeah, and of course Northam got good chrome sales as well, which kind of helps where our PGMs are struggling. Wayne, Sibanye Stillwater?
Yeah, look, I mean, as Deryck said, this is the most marginal of all of them. So you take a risk, and it's amazing how the commodity cycle works. You know, when Neil bought all of these mines from Anglo Platinum and bought Longrow, you got it absolutely at the bottom of the cycle. The share shot the lights out. It was a huge performer. And then the cycle turns down, and now no one wants to touch it. Meanwhile, it's just a cycle. Yeah. You know, and certainly I'm quite positive on the commodity cycle and the PGM cycle over the next 2 to 3 years. I, in fact, think the platinum shares might be one of the best performing sectors in the market over the next 2 to 3 years. But it is risky, unfortunately, because of its marginal nature. I mean, they essentially bought mines that no one else wanted in South Africa. If I was to buy platinum shares, I would rather go for Amplats. Mm-hmm. But if you're keen on the cycle, and you're right, you know, take the most marginal one, take Sibanye.
Yeah, and ultimately, if PGMs run, they're all going to go up. It's going to be nuances as to which does slightly better. A question coming through around property stocks being strong. Deryck, let's start with you. Over the last year, the sector's up 30-35% plus yield on top of that. Is there still some value here? Because they've run, but off a very low base and still discounts net asset value.
Well, I think that for me is really the key, is the big discounts to net asset values that you're seeing at the moment. So to answer your question, I think the easy money has certainly been made. There has also been a re-rating towards, let's just call it SA Inc. in general, which includes a lot of our listed property. So that's re-rated to the upside to a more favorable valuation across the sector. There's yield underpin. So obviously, as rates start to come down, the yields come down and the prices go up. So that kind of inverse relationship plays out through a cutting cycle that we're sort of entering into at the moment. I still think that there is probably some value. You do need the backdrop of some growth. We need some economic growth to really contribute to this, and we need some economic activity to really justify the current prices at the moment. But if we do see further cuts through the course of 2025, interest rate cuts, then I think you could generate some capital upside in some of these property stocks. So my feeling would be that the sector is a buy on weakness, and try and time some of the yields, you know, and pay very special attention to what those yields and what those forward yields look like. But yeah, probably fairly and fully priced at the moment, but weakness and opportunity.
When your take on the local REIT space, as I said, I mean, it's had a spectacular 12 months, although 7 years before that were not so great.
Look, the environment is still quite tough. Lower interest rates help the clients more so than the property companies, because the overwhelming majority of them have edged out all of their interest rate exposure. So lower rates, they benefit from a relatively small proportion of their book, of their loan book on the lower rates. But clearly that helps the tenant, and it helps the tenant's business. So going into a good economic environment is good for the properties. Lower bond yield is very good for the ratings of the shares. Earnings growth for the next year or maybe a little bit more is still going to be low. It's still going to be single-digit earnings growth for the majority of the businesses. A lot of these businesses have got substantial amount of money overseas in other property companies. The strong rand doesn't help that at all. Clearly that's a negative in the shorter term for the property companies, but there are some signs that the market's looking a bit better. The vacant office space has declined quite dramatically. That's good news. And the rental reversions aren't as heavily negative as what they were. And certainly some of the properties, they're almost at zero on the rental reversions. You need strong economic growth so they can get the charge per square meter up, because that has been languishing for a sustained time period. So yes, I still think there's a bit of value there, but as we've all said here, the easy money has been made.
Yeah, no, I take your point. Deryck, let's come back to you. Brait, who, they really are, my sense is they're kind of winding down. They've still got Virgin, they've still got some Premier. Is there value unlock in Brait as it sort of unwraps itself?
It's amazing to see how quickly the share price has actually rallied to R1.50. Just, I think they did a capital raise sub R1 around 88 cents or somewhere around there. But it's a difficult one to call. It does seem like there is a lot of movement of shares. So probably some significant shareholders accumulating stock at the right prices. To me, it looks like they're gearing this thing up for a delisting, and then obviously going to probably look to consolidate and restructure some of those assets. So what that price looks like is difficult to say. I don't know. It just, in terms of the assets that they've got within that stable, I don't know if it justifies the kind of price that we're seeing in the market. It seems like it's kind of been massaged to these levels as there's been massive amounts of shares finding their way into obviously the current shareholding at the moment, which one needs to analyze.
Yeah, it's up from like R1 to R1.50 in a little over a month. Wayne, have you got any sense that there's some unlocked value here?
Look, there could be, but then it's arbitrage. That's not truly investing. It's trying to take unbundling arbitrage out of it. This company has been an unmitigated disaster. I think the high it got many years ago was 150 Rand. I saw they sold some Premier shares yesterday, about 1 or 2% of the company, to get some more money in. But no, it's an arbitrage, and there might be some value unlocked there, but it's not really something you would consider as a serious investor.
Question coming through around diversified miners on the JSE, Glencore, Anglo, BHP Group. Wayne, of the three, which if either would be a preferred?
I think I'll go for Anglo's because of the copper exposure. Glencore's got that huge trading arm which might benefit quite nicely in a commodity upcycle, and BHP's obviously got a good quality set of assets for a mining company, because mining companies themselves are not quality shares, simply because they are so cyclical. But I'll go for Anglo's.
Anglo's. Deryck, Glencore, Anglo American, BHP Group?
I think, just going back to the point Wayne made earlier, I think certainly over the next 2 years, we're probably going to see a much more accommodative environment from a commodity perspective. So the fundamentals and kind of the forward-looking picture for a lot of these diversifieds actually is starting to look quite interesting. Out of the three, my preferred pick, I have to lean towards what Wayne's saying, the Anglos. Remember, this was, They were obviously being looked at by Bulletin not so long ago, and we were talking at a price in excess of 700. Now we're starting to see the sort of disinvestment out of Amplats. They're kind of packaging this thing up almost for sale. And as Wayne says, that copper exposure is what some of the other sort of competitors are after at the end of the day. So sitting at 570 odd rand a share, I would be a buyer of Anglos and hope that there could be some corporate activity at some point in the next sort of 12 months or so. Those copper assets are attractive. So they all look good, but my preferred pick, Anglos.
Yeah, as you point out, I mean, Billiton, we're happy to pay over 700. We're now getting it for south of, 570 as we are talking here. Question coming, Deryck, let's stay with you. Remgro, massive discount to net asset value. Last I checked, about 40%. Is this a good investment? I mean, we've certainly seen the holding companies' traditional discount to NAV widen over the last decade. Remgro used to be a 15 or 20%, but across the board, HCI, Subvest, all of them, wider discounts. Would Remgro be on the shopping list?
I don't know so much, Simon. I think if you want to own those assets, then you must own them directly. So I think any holding company structures tend to trade at a bit of a discount to net asset value for a lot of operational reasons and cost inefficiencies that happen at a holding company level. So, particularly in the South African market, if it was a very mature bull market, there might be an argument to have some kind of a indirect holding via a holding company like a Remgro and some of the assets that they own. But if you are bullish on South Africa and the assets, then hold them directly. There is probably a narrowing of the gap, just given the positive sentiment that we've seen towards SA Inc. at the moment, and that may continue. So it probably continues to sort of edge up and track slightly higher, but I'd rather own the direct companies as opposed to the holding companies.
Wayne, your take on Remgro before we go to stock picks?
Look, I think the discount is too wide. I think there is an opportunity here to make Remgro management are determined to unlock some of that discount. I don't think they're going to delist. I don't think they can find the capital to do that. Maybe they can, I don't know. But certainly they're going to try their utmost to get that value unlock there. They have got some nice unlisted shares, and that's, I suppose, an added attraction to getting Remgro. So yeah, Remgro, I'll take the opportunity there. They've got nice assets.
Let's go to stock picks. Wayne, we touched on banks earlier. Your pick today, going with Absa.
Well, I mean, just to the Absa question, just sort of made it my stock pick. It is looking incredibly cheap. I mean, when you look at I think the PE ratio is the same as the dividend yield.
Yeah, both about 8.
And normally when you get something like that, either there's fundamentally a serious problem in the company, and I don't think that's the case. I think they've just been a laggard. I think they're still suffering from the unbundling. I mean, that was a mammoth task to sort of get out from Barclays. And I think they achieved that without any disaster, except that the other companies, the other banks sort of almost ate their lunch. And I think they're coming back from that. So Absa just looks too cheap to me.
Yeah, I take your point. That what did they call it? The managed separation was undoubtedly, I think, a way bigger deal than anyone outside of that head office understood. Deryck, you want to talk Sasol?
Yes. So I think just generally, if we look at markets at the moment, they are looking a little stretched. We've had interest rate cuts come through. We've had sort of higher valuations on equities in general, both locally and offshore. I am being a bit cautious. So I'm using the strong rand at the moment to actually buy a few dollars and have some cash in the bank to invest in some of the offshore markets. But if you had to ask me for what I'd go for today, I'll probably take a punt on some Sasols. Not the best run business, and they've come through quite a precarious and very tricky environment from a management perspective. But the oil price has been down significantly. I think these tensions in the Middle East may give a little bit of buoyancy to the oil price. Maybe just too cheap, under 120 Rand a share. And if I do see it run towards that 150 type level, hopefully, then I'll move quite quickly on it. So I'm expecting a bit of an uptick in Sasol. The oil price obviously needs to play ball, and just a little bit of a speculative punt as opposed to a long-term hold.
I got you on that. And certainly we have seen oil running overnight with the Iranian attacks into Israel, sent Brent and WTI moving higher. That's all for tonight's Stock Watch. Thanks to our guest, Wayne McCurrie, FNB Wealth Investments. He went with ABSA. Deryck Van Rensburg from Anchor Capital going with Sasol. Up next, the close. Stay tuned.